But I'll call Kenny. I said, Kenny, I need about 20 million in debt. So he'll buy a property and borrow the $20 million so I can amortize and depreciate the property. That's the game of real estate. There are three basic accounting terms you must know, and why I do this here. So when I have debt, okay, which is over here, liability. The reason I want a lot of debt is because my hamburger business is paying for my debt. What is that called?
It's called amortization. So you're paying down the debt with other money.
Does that make sense to you?
Yeah.
So let's say I have $20 million in debt here. Every hamburger is being sold is paying down my debt. Is that tax-free?
That is.
It's amortization. But if you're on this side and you have a house, is amortization tax? Well, not really, but who pays for that amortization?
Well, you pay for it.
Yeah, these guys here are the suckers in this whole deal. I have a big house. That's why most sports stars are bankrupt, because they get the $20 million contract and they buy a big house for mommy and daddy, right?
That's right.
But they don't get this break here. The other word that is important is this word here, and that's called?
Yeah, appreciation.
Appreciation. So what does that mean to you, Tom?
Well, what that means is this is the asset column. It means that as the real estate goes up in value, it's appreciating and you get the benefit. What I love here is where the debt goes, it's the bank's money. That's the bank's money. But you get the appreciation on your money and the bank's money. And that's what's magic to me.
Yeah,
about
so
that.
let's say I have $1 million of my money in here. By levering up, I got $6 million. Now this thing goes up by in multiples of 6. Does the bank take any of that money?
They get none of it.
Debtors are winners, you know. And then we have the third word. So you got amortization, appreciation, and this is the magic word here that most people don't understand. It's depreciation, and this is where it gets tricky. See, why is that? Why is it actually both sides?
Well, because what happens is depreciation is is a deduction for tax purposes, but it's no money out of your pocket. So because of that, what's really happening is you're lowering your taxes. You're lowering your taxes with the depreciation, okay, because you pay on net income, right? So you lower your taxes with depreciation, which increases the amount of cash flow.
Yeah, so let me say this much. So let's say I have $100,000 in here that goes to taxes, but because I have depreciation, I don't have to pay the $100,000 in taxes. So that means my income goes up, but it also means my expenses went down. This is number one of all the things that's hard to understand. This is simple. Everybody knows appreciation. Everybody knows amortization. I paid my car off, I paid my student loan off. But this here is the trick here. You see, depreciation means you don't, instead of paying $100,000 in taxes to the government, I keep the income. That's why it goes up.
Let's say that outside of this, let's say you didn't have this, and you have all this income from your business, right? Or from this business, either one, okay?
But this person can do it too.
This person sometimes can do it, okay? But this person can do it, this person. Let's say that you have all this income coming in, you're paying all this tax. Let's say you have $100,000 of tax, okay? Now you go out and buy a piece of real estate. Well, why does the government give you an incentive? Well, because they...
Not a house now, not your residence.
Not your personal residence. This is investment. So this is housing for other people.
Apartment houses.
Or this is commercial property for a business.
This is an office building that I own.
Exactly, an office building or hotel. Okay, any kind of business real estate.
That's bought with debt too.
Now we add the debt. So now let's say that we had $1 million of your own money and $5 million of the bank's money. Well, we get depreciation deduction, a percentage of the $6 million. So the bank doesn't get any of that. We get all of the depreciation of $6 million. That could be as much as $500,000 a year. And because we've got that much depreciation, that's just a reduction of our tax expense.
Right, so it's 500,000 extra in income, but it's actually called phantom income.
Right, so what happens is because now we have less income for tax purposes, right?
We don't have to pay
we have less income for tax purposes, so now what happens is we have to pay less taxes, okay? Because we're taxed on our net income. We're taxed on our gross income minus our business expenses. And in this case, a business expense of depreciation is like magic because it's not money out of our pocket. We're still appreciating, we're still making money here and cash flow from the property.
Right.
Okay, and at the same time, we're reducing our taxes. Well, anytime you can reduce an expense, now I'm an accountant, and so I love reducing expenses. And every time you reduce expenses, it's like putting money in your pocket because now you have more that you didn't spend.
Right, so this is the same number. So let's say it's 500,000. It means 500,000 in income you didn't have to spend, but it was caused by 500,000 in expenses you didn't have to spend. So you pay nothing for taxes.
How does depreciation work in that country? Sometimes it works only on new property. Sometimes it works on used property. Sometimes you have to build it yourself. So whatever it is, the tax laws are there. Here's what's going on. We talk about this all the time. The government's your partner.
Yeah.
Well, if you're an employee, the government's taking 40% of your money. They're your partner, they're a silent partner, and they're giving you nothing back for that, okay? If you're a small business, they're taking 60% of it. But what happens is that if you start doing what the government wants you to do, big business, investor, investing in energy and
real estate,
food, water, all those things, you start doing research, okay? You start doing things the government wants, they'll say, look, we know that that's risky. As your partner, we will contribute to that cost. And that's really all depreciation is. Depreciation is just the government's contribution, okay, to your real estate investment. That's all it is.
Yeah, and then kind of the cliche term is between Tom and I is I want more phantom income. Phantom income means money that stays in my pocket or doesn't go out of my pocket. It's the same money.
Right, and you make a good point that if you're buying your own house, for example, you're not going to get that tax benefit. There are some countries that have small tax benefits for your own house. What they really want is for you to build housing for other people, okay? Then you're being generous, and then you get the tax benefit.
We're all about starting small, get the knowledge, get the experience, get the education, and then build from there. I think that's just a difference in philosophy. And
have we had problems with partners?
Oh yeah. Especially when it comes to money. I mean, money is a psychotic subject. And so if you're only going into real estate for the money and the return, then probably Rich Dad is not your philosophy to follow.
Right.
But if you're in it for the long term, for the education and to grow it and to hang on to it, then yes. So as you're saying, I started with a little 2-bedroom, 1-bath house,
Portland, Oregon.
Portland, Oregon, $5,000 down payment on a $45,000 house. Nervous, scared about making a mistake. What if the market turned? What if the tenant moved out? All of that. But it was these small properties. Then we went from another single family, went to 6-plex, went to a 12-plex, went to an 18-plex, and every time more mistakes, more learning, more knowledge. But now we can do the big deals because we've got that foundation of education and experience behind us.
Right. And for us, the question is, how do you find a good deal? Well, you got to look, but you got to know what you're looking for, and that takes a while to learn, right?
Yeah, what kind of real estate and where is it? And I mean, the landscape has changed so dramatically in the last 2 years with all the migration, as you talk about, Robert, people moving out of states to get to more non-regulated states where they want their freedom. As Grant said, the blue states are very, very popular right now.
Right. And the other thing, too, is interest rates going near zero.
Excuse me, the red states are popular, not the blue states. They're moving from the blue states to the red states. I get my colors mixed up.
So anyway, with interest rates dropping so low, that's why people are kind of jumping into real estate because it makes it affordable. But when they drop interest rates, prices go up. And so today, if you talk to most people, we're in a bubble. And that's the dangerous part, because I'm not saying they will, if they raise interest rates, the bubble busts. And that's why I'm talking about liquidity. Liquidity is how fast can you sell it? For example, if I buy a new pair of, let's say, shoes, and I pay $100 for the shoes, how long will it take me to sell those pair of shoes? Well, take me a while, because nobody wants them. And it's the same with real estate. If people don't know what it feels like to have a piece of real estate nobody wants, for whatever reason, they don't want it.
Well, look at the commercial office buildings now. They're all empty. Yeah. If you can find a way to repurpose them, great. That's what's needed right now. But I wouldn't want to own a big office building right now anywhere.
No, you have to, I highly suggest, because real estate is, once you buy it, you bought the Titanic. It'll either take you to heaven or it'll take you down to the bottom of the ocean. And thank God we've never had that happen to us. But also what happened was when Kim, as we got more successful buying the property, and Kim was the property manager. And then what happens, property management consumes you. Just like your dad said to you, I don't want to fix toilets. And well, nobody wants to fix toilets, but that's what the property manager does. Plus, it's a contractual agreement between you and the renter. And they can violate, and they can trash the property. We've had property managers steal from us. It's just one big zoo. It's a Jerry Springer show on steroids once you get into property management.
And it's harder. It's harder to self-manage your properties, but the education and the knowledge you get, because even when we had an on-site manager, we're still the owners of the property. We still make the final decision. I'll never forget many, many, many years ago getting a call at 11:30 at night, and this tenant was trying to move out with our stuff. It was a furnished house. They were taking the refrigerator, the stove, and the police had to come. And it's like, I look at that experience now, I wouldn't trade that for anything.
So at Rich Dad, we always recommend you learning by experience to do what you do. And then you can go through the process, because it's a process. Remember that guy, Kim? I still remember he wasn't paying you rent. And I walked up to the place, and Kim had to evict the guy. And I gave you so much credit, because he was about, let's say, 35 years old, pretty muscular. And Kim's standing there, and the sheriff serves the guy for the eviction. I tell you, you haven't evicted somebody, it's pretty interesting. So the guy is coming down the house, he's emptying the property, and he's giving us the stink eye. He goes like, it's Christmas time, I got 2 kids, but he still didn't pay the rent. And so he's being evicted, and every time he moves the stuff onto the sidewalk, he gives us a stink eye. And I felt for you, Kim. Kim's she's not very muscular. She's very attractive, but not muscular. This guy's giving her the stink. I know. But this was the funniest thing. Kim says it's worth the misery. So this guy's giving me a stink eye. It's Christmas time. I think he's got 2 daughters. He's dragging his Christmas tree out and all this stuff. And he comes up to me, and he's still giving me the stink eye, and he says, it's Christmas. And Kim just holds the line, and what am I going to do with my furniture? It's all on the sidewalk out there. And and this truck pulls up. And they loaded his furniture onto their truck.
They thought it was rubbish.
Kim and I sat there talking to him. I'm looking over his shoulder, and these guys are, oh, it must be Christmas. And they're throwing all of his furniture and his Christmas tree on their truck. And I said to him, well, if you keep talking to me, pretty soon you won't have anything to move. Remember that, Kim?
I remember. And, that goes back to another really valuable lesson in that same situation, is you also have to understand the rules around rental properties.
Yeah.
And some states are very pro-landlord, and some states are very pro-tenant. And Arizona was very pro-landlord. So when I took that case to the circuit court for eviction, the judge actually reprimanded me, and she said, this person hasn't paid rent in 4 months. How come you have let him go this long? And I'm like, well, I'm trying to help him out. I'm trying to be nice. It's getting near the holidays, and just trying to help. She's like, you have to enforce the law. You have to enforce the rules. That you should have evicted him 3 months ago. And she read me the Riot Act. But It was again, had I not had that experience, I wouldn't have understood how the laws operate and what needs to
Right.
happen. So yeah, the hands-on, doing the real thing, it's where real learning happens.
Yeah, and she's still a personal friend of ours, isn't she?
Yeah, the judge.
She's great. She says, by the way, I read Rich Dad Poor Dad. Yeah, it was a crack up. Real estate is not like a mutual fund or a stock or a bond. You buy it, you own it. And if you make a mistake, you really own it. Nobody else does. That's why. So real estate is a very different game. We love the game. I mean, it's the best game in the world.